Hey everybody, I'm Mike DeSepoli and welcome to the Ask the Advisor show. Ask the Advisor is brought to you by Heritage Financial Advisory Group. And this week in episode 94, we're going to talk about 5 things you can learn from stock market corrections that will make you better prepared the next time one comes around. You know, we understand nobody out there likes these stock market sell-offs, but as sure as the sun will come up tomorrow, you will deal with these again in the future. So we want to give you a couple key points to help you be better prepared for the next one, because the reality is it's times like these that separate the good investors from the bad ones. So number one, the most important thing you could do is do not let the headlines scare you. You know, anytime the market has a little bit of turbulence, a little bit of volatility, all the prognosticators come flying out in the news media and they tell you how this is the beginning of the next big crash. This is 2008 all over again, 2001, 1987, the Great Depression, on and on and on. And the reality is nobody knows anything. Nobody knows what direction the market's going today. They don't know what direction it's going tomorrow, and they certainly don't know what direction it's going 1 month from now. But what you have to understand about media, particularly news media, is that stability and calm do not sell newspapers and they do not drive viewership. So they latch onto fear, they latch onto panic, and they push this narrative, and it causes investors who don't have a strategy, who don't have a plan, to get emotional about what they're doing in their portfolios. And the first step towards making bad investment decisions is allowing your emotions to dictate what comes next. So the first thing we would implore is do not let the headlines scare you. Remember, the stock market is in the longest bull market run starting in 2009, and it's had positive returns each and every year since then, and yet there's been many corrections along the way. So corrections do not spell the end of an economic cycle. They do not spell the end of an uptrend. It's important you evaluate the fundamentals behind those markets. Number 2, don't react, but definitely reassess. You know, times like this, times like corrections in the market is a very good time to reassess the levels of risk in your portfolio to see, have you been taking too much risk, chasing big gains? If there was better days ahead, would you reshuffle some of the pieces in your portfolio? But we implore you, do not react unless you see fundamental breakdowns in the economy, in the markets, or whatever particular investments that you own. There's got to be a non-emotional process in place to evaluate these things. If you are reacting just off sheer emotion, you are destined to make bad decisions, because what happens is when the market starts cascading and falling very quickly, people with no plan, they sell into that weakness, and then a week later, a month later, the market's bounced and is now trading higher, and they just feel sick to their stomach about it because they locked in a loss, and now they're chasing the market as it moves away from them. And these are the people that sell at the bottom, they buy at the top, they rinse and repeat, and they tell you that you never make money in the markets because the market is rigged. The market is not rigged. It's rigged against people who don't have a strategy and they don't have a plan to get them through the tough times. Number 3, if the market is selling off and after you reassess your portfolio, you deem that it's time to make a change, it's not too late to make a change. You know, the reality is the market is down 3 or 4% from all-time highs. By all means, you still have an opportunity to make changes in your portfolio. Yeah, in a perfect world, we would all make those changes at all-time highs of the market, but nobody times the top perfectly right. I don't care what they tell you, how many people run commercials on TV. They tell you that they're going to pinpoint the exact turning point in the market. It is absolutely impossible, and anybody that's telling you otherwise is just outright lying to you. So if you reassess, you decide changes need to be made, better to make changes down 5% than to make changes down 50%. Number 4, if you have any loans, it's a good time to revisit their terms. You know, maybe you're sitting on some additional capital in the bank, you were thinking about investing it, but you know what, market's going through a little turbulence, so revisit some of the loans you have, some of the credit you have outstanding. Maybe it's a good time to pay down some of the debt you have. If it's at an unfavorable interest rate, it could be a great time to bring your financial house in order. And number 5, if you have cash or bonds, we would encourage you, particularly in a rising interest rate environment, to avoid long-term commitments. You know, now if you're a borrower, if you're getting loans, if you're on the receiving end of credit, of course you want to lock in low rates for long periods of time. But in the environment we're in right now, where interest rates are moving slowly higher, and they are projected to move higher over the next several years, it really wouldn't make sense to buy an income-producing investment like a CD or a bond and lock yourself in for long periods of time, because now you're locking in today's lower rate when in 6 months, 12 months, 18 months from now, rates could be higher. So if you are a bond investor, if you are a CD investor, I would keep your maturities inside 3 years if possible. The shorter the better. This way, as rates go up and different bonds and CDs and investment products start paying better rates, you have the ability to shift to higher paying products. So don't lock yourself in for the long term. So these are just 5 things you can learn from market corrections that will better prepare you for the next one. Remember, you don't want to have a herd mentality. You definitely don't want to follow some of the advice you're getting on the news media. The time to be greedy is when others are fearful, and the time to be fearful is when everybody else is greedy. And that's from the great Warren Buffett, one of the greatest individual investors of our time. So if you have any questions about how you should personally react to stock market corrections, or maybe this latest correction, caught you off guard, got you back on your heels, started to realize that maybe you don't have a strategy in place, or maybe you are taking too much risk, we'd be happy to talk with you, so please reach out to me privately. And if you know anybody out there that's not getting the service advice that they deserve, please send them our way. It's our goal to make sure investors are increasing not just return on investment, but their return on life as well. Thank you guys for tuning in. We'll see you back next week for episode 95.